Over the years, S-Corps have become all the rage. However, not many people actually know what they are. You may hear your friends, neighbors, and YouTubers insist that this is the silver bullet to a windfall of cash. But just like everything else, there's a bit more to unpack. Let's first start with what an S-Corp is not. This entity is not a legal entity at all. In fact, it shouldn't be confused with an entity altogether. An S-Corp is a tax strategy. It's an election aimed at minimizing self-employment taxes, amongst other things. If you've been in business for yourself, you know that self-employment tax can be a bummer come tax time, especially if you've always been a W-2 earner. Since you've probably received a paycheck before, you're probably familiar with FICA. What you may not have known is that that portion on your check is only half of the equation. Your employer is actually picking up the other half on your behalf. Now that you're working for yourself, you'll have to pay both sides for a total of 15.3%. Well, that obviously sucks. There goes another 7.65% out of your pocket. That's where the S-Corp comes in to save the day. If you're an LLC and you elect to be treated as an S-Corporation for tax purposes, you still receive limited liability protection, but you also receive a tax break on self-employment tax. Now you need to ensure that you don't pierce the corporate veil, more on that in another video, but ultimately you'll get to have your cake and eat it too. So how does it actually work? Well, glad you asked. As a pass-through entity, you pay self-employment tax on net income to your business. If you elect S-Corporation status, you only pay self-employment tax on your salary. The remaining distribution is tax-free. Well, not really. You still have to pay applicable federal and state income taxes, but you do get a break on self-employment tax. Your initial thoughts might be that this doesn't seem like that great of a deal, but let's go through an example. There's a little bit more to the calculation, but this should help you in your overall understanding. Let's say that you have a business that makes $100,000 after all expenses. If you're a sole proprietor or an LLC, you would have to pay $15,300 in self-employment tax. However, if you elected S-Corporation status and you paid yourself a reasonable salary of, let's say, $40,000, then only $40,000 would be subject to that 15.3%. That means that you would only be responsible for $6,120 in self-employment tax, not the full $15,300. That's a nice chunk of change, and now you know why S-Corporations have become so popular. I didn't even cover Section 199A, which also allows for pass-through entities, including S-Corporations, a further reduction of 20% of net income. Now, when you factor that in with self-employment tax, it's almost a no-brainer. So with all the benefits I discussed above, it may seem like this is the ultimate strategy and everyone should actually claim it. However, this still may not be the best for your business. There are instances in which electing this strategy could end up costing you money and being more of a headache than it's worth. And there'll be more on that in one of my next videos.